Okay, so I'm going to pick up where I left off on pricing a loan, and we will go through pricing a loan and try to get to the other critical points about reducing credit risk, how financial institutions reduce their credit risk. So let me share my screen so you can just see the slides. As you know, I have the slides up and I speak to the slides, but I usually add some more information. So remember to take your notes. Right. So in pricing a loan, the financial institution is going to look at the return on a loan. And the return on a loan, it's a calculation which includes the interest rate on the loan, any fees that are relating to the loan. So anything like negotiation fees, any other fees that a bank may want to charge on the loan. Then you have the credit risk premium, which is that extra that the financial institution is going to charge a customer based on the potential credit risk that the borrower poses to the financial institution. You also would include any collateral that backs the loan and any other items, for example, reserve requirements. Reserve requirements are needed because the bank has to pay reserve requirements to the central bank for the deposits, and it's using these deposits, and so it recoups that reserve requirement cost from the loans that it offers. So we look at the different elements, right? And so what you see here, if you look on the screen, you'll notice that there's the base lending rate, okay? And so the base lending rate is going to reflect the financial institution's weighted average cost of capital. So what the institution is paying itself on for its capital or its cost of funds, right? So whatever the cost of funds are, whatever that financial institution, whatever cost that financial institution is incurring, right? And the cost of funds could be the commercial paper rate. It could be the Fed funds rate in the United States. It could be LIBOR, which is London Interbank Offering Rate, which is used in London. It could be the rate that it has to pay on other loans. All right. And so the return on a loan looks at direct and indirect fees and charges that relate to the loan. And so these include the loan origination fee. It includes the compensating balance requirement, a reserve requirement, and the risk premium, as we said. And so you're seeing there the formula for working out the return on the loan. And we're going to do an example a little later on. So the formula being 1 plus K, which is your cost of capital, is equal to 1 plus, this is a big formula, the loan origination fee plus the base rate plus the risk premium divided by 1 minus your compensating balance times your reserve requirement, right? So we're going to break that down, and we're going to we're going to go through this example, but I just want to finish going through the different aspects of monitoring and determining the amount of credit risk that the financial institution is exposed to. I am going to, you know what, let me not go forward. Let me just go through this example really, really quickly. And then we will pick back up. So I'm gonna switch screen share here and pick up another screen that I'm working with. All right. So so you can see the calculation. So what I have up on the screen there is the formula for calculating the return on a loan, right? And so I would have read that out to you. And we're gonna do the same example that you saw on the screen earlier on. And so the loan rate on a loan is 14%. So you have in this example, the base rate, all right, you have in this example, you have a loan rate, a prospective loan at 14%. So the base rate is 12%. All right. So I'm gonna just write this up here. So your base rate equals 12%. Your M, or your risk premium, is 2%. All right. It charges a loan origination fee of 1/8%. So the origination fee is 1/8%, or 0.00125. All right. And it imposes a 10% compensating balance. So your compensating balance is 10%. All right. And there's a reserve requirement of 10%. Okay. Reserve requirement. So if you were to plug these numbers into the formula, we would have 1 plus K is equal to 1 plus, you remember that loan origination fee? Remember that fee? So your origination fee in this case was 1/8%, which is 0.00125, plus your base rate was 12%, so that's 0.12, plus that your risk premium, which was 2%, or 0.02 when we write it as a decimal. Okay. And we are going to put all of that, because we're using the formula, my crooked lines, 1 minus, okay, 10%, 0.1, or 10%, times 0.9. Remember, the reserve requirement is 10%. So what we do, we subtract the 10% to get that 90%. Okay. So the set aside reserves at a rate of 10% of deposits held at the Fed. And so you would subtract that, 10%, and that's where the 0.9 comes from. So that's the 90%. All right. We put that in brackets and we do the calculation. So 1 plus K is equal to 1 plus 0.14125 divided by 0.91. Okay. So when you calculate, when you work out this part, this is what you get, right? Okay. When you work out the top, this is what you get. Okay, so 1 plus K is equal to 1.15562. So K is equal to 1.1556. Sorry, not 62. This should be, I made a little error there. It should be 1.552. Let's erase that there. That's wrong. Okay. Minus 1. So K is equal to, let's fix my K there. Okay. So your K, or your required return, is 0.1552, or K is equal to 15.52%. All right. So I'm going to assign a couple of questions. I'll post them in Moodle so that you can do those. All right. I know just working one may not be sufficient for you, but you're going to use this example and you're going to practice. So I'm going to post in Moodle some practice questions. All right. So let me just go back to, I'm going to go back to the slides. And so you have that example worked out there for you. All right. And like I said, we are going to have a look at some more examples. You are going to work them and we go over them. I'll go over them in tutorials. All right. For the 2005 group, we will, I will post an online tutorial, bearing in mind that I would have noted that we will skip the online tutorial this coming Friday, but I will do a tutorial as an asynchronous tutorial, but we will still go over them even though I do that asynchronous tutorial. All right, and that will be posted in the Moodle. So what we just calculated was the return on the loan. So given all of the different elements, your loan origination fee, your interest rate, your compensating balance, your reserve requirement, given those, you can calculate the return on your loan. But how do you determine what is the expected return on the loan? The financial institution can do that as well, right? So because there's default risk, the financial institution wants to have an idea what the expected return on the loan is going to be per dollar lent to the lender. So the return, the expected return, can be different from the promised return. Okay? And so we're going to look at the expected return versus the promised return. And so what you have there, the expected return is the probability of the full repayment of the loan. All right? Such that the financial institution is going to get your principal and the interest as promised. Okay? So you have 1 minus P. So that's the probability of default. So 1 minus P is your probability of default, whereas the chance that you will have a full repayment is P times 1 plus K. K being your cost of capital. So the expected return of the loan is going to be, the expected return of the loan is going to be equal to, is going to be this right here. All right, this is going to be expected return on the loan. So there's a formula you keep in mind. We will have a look at that a little later. Okay, so you can have the return on the loan, but the bank can also calculate the expected return on the loan. All right, the expected return being that return that you expect to get because the person is not going to default on the loan. So it's the probability, the expected return is the probability of a complete repayment, P, times 1 plus your promised gross return minus 1. And so we're going to I'm going to set some examples, some questions on that for you to do. I will place those in the portal as well, and you will practice those, and we'll go over them in tutorial class. Now, in determining credit risk, there are some models that are used by financial institutions, right? They're called default risk models. And default risk models are used for loans and for bonds. There are different types. They can be qualitative, and they can be quantitative models as well, right? So financial institutions assess default risk using different types of models. And the quantitative models, there are a few of them, all right? Then they have the qualitative ones. The financial institution can use a combination of both models, all right, to come up with a decision on how they're going to price the loan. So they use the qualitative and the quantitative. So financial institutions get involved in some really technical models. The Bank for International Settlements, for example, suggests some, but financial institutions, based on the historic data they have come up with, financial institutions through researchers have come up with some credit risk evaluation models. Like I said, some are qualitative, some are quantitative. So if the financial institutions do not have information available to them out there in the public, like if they don't have a credit bureau, then they have to pull information together. All right. So they may get information from the credit agency, from the credit bureau. They're going to get information that they have internally on particular borrowers. They can look at their information on how many loan defaults they have, what is their percentage of loan defaults to successful loans, successfully repaid loans. So they gather all of this information and they come up with information that they can use. So they have, in the qualitative models, you have what you call the borrower specific factors, all right, which are based on the individual borrower. You can get that borrower's credit rating from the credit bureau. You would also get the borrower's current financial information. So how much the borrower makes, what are the borrower's obligations, financial obligations, and you get all of those. And then you add to that the market specific factors, which are going to impact all borrowers. So you're talking about the systematic risk here, the factors that create that systematic risk. And so the financial institution will put all of these together, it will weigh them, and will come up with a decision as to whether or not it's going to give the loan. And if it's going to give the loan, what pricing, which we just did, it's going to apply to the loan. And so financial institutions use what we call the 5 C's of credit: character, capacity, conditions, collateral, and capital. So they use those for their qualitative. And so when you look at each of them individually, when you talk about character, you're talking about the person's willingness to pay. Has this person defaulted on loans before? Is this person paying their credit card bill? Does this person have a bank overdraft? And is the person paying the bank overdraft? You're going to look at the person's bank background, the experience, the ability to pay, ownership. All right. Is this person always available to you? What are some of the person's outside interests? Are they involved in other activities that could prevent them from paying their loan? All right. If it's a business, what is the legal form of the business? If it's an individual with a business, what is the legal form of their business? What is their payment record like? Do they have any bankruptcies, any litigation that's going to cost them money, which if that's going to cost them money, it's going to limit how much they can pay you, and settlement of any obligations. What is the capacity of the individual to pay the loan? So what are their projected cash flows, whether individual or company? What are their projected cash flows? What is their consistent earning over time? All right. So does the person have adequate work? If it's an institution, do they have adequate working capital? So they're going to look at their financials to get their profit margins. They're going to analyze the income. Where's the income coming from? How frequently does the income come in? And they're going to look at their expenses. What is the income generating capacity of the business? So the bank may ask the business to bring in a business plan. All right. What are your production and business trends? What's going on in the market that you are in? What is the future plans of the business? So that's where the business plan comes in. Business plan is going to show forecasted cash flows. Business plan is going to show what are the plans for this company going forward. Then you're going to couple that with the economic outlook. What are the conditions? Financial institutions will look at the different conditions, all right? So conditions are the guidelines and the obligations drawn up in a loan contract. Those are controlled by the loans officer. So specifically, the loan purpose is there, it's documented. How is the loan structured? Is it what is the maturity period? What is the amount? What is the interest rate? How is the person going to pay? How much is the payment per month? All right. Based on the applicant's cash flows, the management skills, the financial condition, and the economic life of the project or the asset being financed. What is the level of loan risk? Costs of extending the credit, competitive market forces. So the loans officer is going to look at all of these conditions. And then it's going to look at collateral. Is there collateral available? Is the collateral marketable? In other words, what are the chances that if the person defaults or the institute or the company defaults, what are the chances that the collateral can or cannot be sold? Or can it be sold quickly? All right. What is the condition of the collateral? So you may have the company or person may have put up a building as collateral. What is the condition of that building? What is the value of that building? So the financial institution is going to assess that. What is the quality of the collateral? Not just the value, but the current condition, the value. Is it collateral that the bank can benefit from? Okay. What is the bank's lien position? In other words, does another institution or person have claim to this collateral before the financial institution? All right. Protection from loss if the loan is defaulted, that's called insurance. Okay. Measurement of the collateral using net realizable value. All right. So they're going to look at the net realizable value. What it is that the financial institution can reasonably get in the market if they were to sell this collateral. Then you look at capital. Does the borrower have capital, money, property, any other valuables that the borrower may have? So they're going to look at the borrower's other assets. All right. They're going to look at, if the borrower is a company, they're going to look at the financial structure of the business, look at the liquidity, if they have cash, ready cash. All right. What is the financial situation? Is the business, solvent? All right. If the business has debt, what does it look like? Is the debt loans? Is the debt bonds? Is the debt, how does the company raise funds? Is it through bonds? Is it through stocks? All right. So it looks at the net worth of the company or the individual. What are the loan obligations? Current loan obligations. Are there any contingent liabilities? This is relevant for companies. What contingent liabilities could be a pending court case that you don't know the outcome of it. It could be something that could happen, but you're not sure, 100% sure if it could happen, that would impact the applicant's, the borrower's ability to pay back the loan. All right. How does the borrower get its funds and how does it use its funds? So the source of funds and the use of funds. So if it's a company, a firm is going to look at the firm's cash flow statement, it's going to look at the income statement, going to look at the balance sheet. All right. Now, when we look at the 5 C's of credit, you're not looking at the 5 C's of credit in a vacuum. Right? So with the 5 C's of credit, you're going to compare that to a similar company. If it's a company, you're going to compare it to companies in similar industries. If it's individuals, you're going to compare one individual to another individual that you have given a loan to. Okay. You look at the 5 C's as a whole, not individually. So you have to bring them together because one individual may be low, the capital may not be where you want it to be, but the collateral could make up for that capital, right? Something like that. So those were the qualitative models, all right, where you focus on the 5 C's of credit. Okay, if we just go back very quickly, what are the 5 C's of credit? Character, capacity, conditions, collateral, capital. So you go back to the 5 C's. Those are the base of the qualitative models. Remember, you don't use them in isolation. You don't use them individually. You use them together. And of course, the success of that model is going to be dependent on the experience of the loans officer, the loans committee that's assessing. All right. Because generally, a loans officer alone does not make the decision as to whether the loan should be given or not. That loans officer will assess, make recommendations, and then a committee, especially if the financial institution has a board of directors, they will have a credit committee that will review loan applications and the recommendations that come from the loans officer. There are quantitative models, which are you scoring the person. All right. So credit scoring models are quantitative models, and these use the characteristics of the borrower to calculate the score, which represents the applicant's probability of default, or to categorize borrowers into different default risk classes, right? So you may say that quantitative models are more objective, right? Yes, because they're more objective, they're more scientific. So they tend to be more accurately determine the borrower's performance without having to use a significant amount of resources. So what you do is you're going to represent the different elements by scores. There are different types of models. There are linear probability models. There's what you call the logit models and the linear discriminant analysis. Those are the three broad types, right? Linear probability models obviously means that you're going to be using probability. You're going to use a method that is linear, all right? It's statistically sound. The output from the model is going to give you some critical information, but the linear probability model has a weakness, all right, because it doesn't give you what you consider to be a proper probability. That's so with the linear probability model, you're going to it's the probability of default with certain factors included. So you have your linear probability. So the probability of default is equal to some number times the debt to equity ratio plus some other number times your sales asset ratio. All right, and that's based on past default. So if you have a prospective borrower that has with this example, debt to equity ratio of 0.3 and a sales asset ratio of 2, the expected probability of default can be estimated, right? It can be estimated because you're going to use the specific factors involved here, and you run the equation. We'll do some examples of that in tutorial. Then you have what we call the logit model. It's a special case model, so it's restricted between 0 and 1. Okay, with the probability model, the difference there, it's probability of default is less than 0, probability of default greater than 1. So that one has limitations. The logit model, it's an interval, 0, 1. All right, so, and that's mathematical. So the outcome represents real probabilities because you're only between 0 and 1. Right? And so you're using logic functions. You're using exponential functions, so log functions, okay, or logistic functions, log, that's where log comes from, logistic functions, to work this out. Now, obviously, you're not going to work this out by hand. There are computer programs that work that work these out for you. Now you have another type of model. You have the Altman's linear discriminant model. With that model, it looks at, it gives a z-score. Again, that's a statistical model that combines working capital over total assets, retained earnings over total assets, earnings before interest and taxes over total assets, market equity book value, long-term debt, and the sales over total assets. So probability of default, all right, depends on these ratios, because working capital to total assets, if your working capital to total assets is a certain amount, it's going to affect the probability of default. Your retained earnings to total assets, if your total assets, if your equity is made up mostly of retained earnings, and you put that over your total assets, that's going to affect your ability to pay. Earnings before interest and taxes over total assets. Your earnings before interest and taxes is going to affect your ability to pay, because remember, you have to take the taxes from the earnings. And if your earnings before interest and taxes is not enough for you to have your net income to be positive, then that's going to affect your default. Your default rate. Sorry. All right. And so the Altman's linear discriminant model uses these factors to determine default. So any firm that has a z-score of less than 1.81 should be considered a high default risk model. Between 1.81 and 2.9, an indeterminate default risk firm, and greater than 2.99, a low default risk firm. So the higher the z-score, the lower the risk. All right. We'll have a look at those models, but I just want to bring those to your attention. And then there's some other ones. The term structure-based model. So you look at the term structure of interest rates, meaning based on maturity, interest rates are higher. All right. You use the term structure for pricing, term structure-based method for pricing. You look at mortality rate models. You look at the ROC models. You look at Moody's Analytics. There are different types of models. So the ROC model, you're looking at the annual return on a loan, all right? And the annual return on the loan, 1 year net income on a loan versus the loan asset risk or capital at risk. So that's the RAROC type model that is used. The loan risk is estimated from loan default rates or using duration. Remember, we spoke about that concept of duration and interest rate risk. So we'll go into more detail in discussing these models. All right, so I'm not gonna spend a lot of time on these. And then we will focus on loan portfolio and concentration risk. Loan portfolio and concentration risk utilizes the concept of portfolio management. The models that we looked at before looked at how the financial institution can measure the default risk on individual instruments, right? Whether it's a loan or a bond. With the loan portfolio and the concentration risk, instead of looking at a credit risk one loan at a time, you look at credit risk in the whole portfolio, right? So you're not looking at one loan, you're looking at the entire portfolio. So you're able to assess the risk or return on the overall portfolio. So you're going to use that in conjunction with your individual loan risk. Okay, so financial institutions want to do the two. So when you look at the overall portfolio, you try to diversify that portfolio. So you want to reduce your concentration, the concentration risk of your portfolio by having several different types of loans so that you reduce your exposure. All right. There are a couple of loan concentration models. You have the migration analysis. We'll go into more detail on that next class. And the concept of concentration limit. All right, so we are going to focus on your migration analysis and concentration limits next class. All right, so if we just do a quick wrap up of this, we looked at the different models used, we looked at the qualitative models, we looked at the quantitative models, we looked at return on loans, what goes into loan pricing that's going to give you a particular return. We looked at expected return on loans, right? So after we looked at the loan pricing, we looked at the expected return on loan, we looked at the models that financial institutions use to assess default risk. You had the qualitative, which focused on the 5 C's of credit and other information that the financial institution gathers. Then you have the quantitative ones that focus on historical trends, historical information, and utilizes different types of models, the linear models. So your Altman, the one which gives you the Z-score, you look at the other probability type models. And so we will go into these in more detail. The latter two, your loan portfolio and concentration risk, we'll focus on those next class. So we look at migration analysis, we look at concentration limits. All right, so go through this lecture, go over the slides, read your text, and I will post the questions for you.